Hey everyone, thanks for joining. This is David, your mortgage broker out of Los Angeles, California. Today we're going to talk about credit. So, why is credit so important? Credit is very important, especially in the United States, because this is, in essence, what your handshake is worth, or your name is worth in terms of paying back, or the ability to pay back someone. And now that somebody has become a bank, usually credit cards or any major bank, mortgage company, any auto financing agency. So depending what score you have, higher or lower means your ability to pay somebody back. And if you're a bank lending people money, you're going to want to lend people money that have the ability to pay you back or have a good history of paying you back. So your credit is tied to your social security number, and this stays with you for your entire life. So when you run your credit report, you can see all the accounts that you've had in the span of your life, including closed accounts dating back to even 10 or 20 or 30 years. It would stay on your credit because it's a history. It's your footprint of credit and your digital footprint that you've been accumulating throughout your life. So if you have a credit score in the 700s versus somebody who has a credit score in the 600s, this literally can mean the difference of having a 4% interest rate or a 5% interest rate. And here in Los Angeles, where the mortgage loans are an average of $500,000, it could be a heavy sum every single month or every year. And now, since mortgages are typically for 30 years, it could be a lot of money over the span of 30 years. Remember, when you build your credit score up, if you're already a homeowner, you can always refinance, usually after making 6 mortgage payments, right? So what can you do to get your credit score into the 700s? First, we're going to look at your active accounts in good standing and your collections. We will first focus on your active accounts in good standing. If you have, let's say, 4 credit cards, 2 of them maxed out at $2,000, one at $500, and the other maxed out at $300, instead of getting money and applying an extra $100 to each account every single month, what I want you to do is make the minimum monthly payment on each account. Of course, you got to make sure you're working and you still have money for those expenses like gas, food, weekly expenses, traveling if you have to travel for work and such. So that extra money that you have at the end of every week or of every pay cycle, you want to go ahead and attack the smallest account first. That $300 account, pay it off, or attack it and give an extra $100 every month or every paycheck. And when it's at zero, you keep making your minimum monthly payment on all the other accounts, and then you attack the biggest account, the bigger one, which is $500. And then when you pay that off to zero, you want to attack the bigger 2 accounts. The biggest 2 accounts, let's say they're both maxed out at a $2,000 limit. If you want to decide which one you want to pay off first, check the interest rate on each of them. On average, credit cards have an interest rate of 20 to 24%, especially if you're just starting to build your credit and you're in the 600s or you're still growing. You start getting these 1 point something percent offers on credit cards and such once you're in the 700 plus range. You don't get them when you're in the 600 range. So it's very important that you build up to this goal, right, of being in this golden bracket of 700 and above credit score. Remember, there are 3 bureaus: Experian, Equifax, and TransUnion. Your goal should be to have all 3 of them in the 700 and above range. So going back to the credit scenario that I gave you, the $2,000 limit credit cards, pay off the one with the highest interest rate first and then attack the other one, right? Why? Because the one with the highest interest is the one that's costing you the most every single month. Now, let's say you finish paying all that off and you just have collections. Start attacking the collections in the same aspect that you were attacking your active accounts. Start with the smallest one first. The ability with the collections is that you can call the companies and negotiate with them. Tell them, hey, I want to pay this collection off. What can you accept as a minimum amount to have this as zero balance? A lot of collections guys accept anywhere from 60 to 80% of the balance. So just call your collection agency on that account and negotiate with them. And if you don't have the money, at least you know what you have to save to pay them off in the future. And that would be your goal. Finally, make sure you have at least 3 credit cards in good standing that are open every single month. Your credit is reported every month to these 3 credit bureaus, Equifax, TransUnion, and Experian. So when they report, they want to report the good stuff and the bad stuff. They have to. So the positive thing of having 3 credit cards is that they're going to report that positive history every single month, and your score can keep working itself and going up. If you don't need to use your credit cards, I recommend using like a 10% balance on each credit card, which in some cases can be 10 to 20 bucks on each account. And that's a small balance. In some cases, the credit cards would say that your monthly payment is $0. This just helps you build credit every single month if you already got to that point and left everything else at 0, which should be everyone's goal. Why? Because again, you're going to take advantage of using your good credit for these big purchases, like getting an SBA loan to open a business, or purchasing a property to get a mortgage, or maybe even getting an auto loan, right? I've heard a lot of cases where they say 0 interest for 24 months. But what you don't know is after those 24 months, your interest rate is like 28%. And a lot of the population that goes into these predatory contracts, predatory lending contracts, don't know that, because they say, I'll pay it off in 2 years. I'll pay it off a lot sooner. Instead of paying that off and having those little debts every single month, save your money after you have your credit in a 0 balance. Obviously, mortgages are one of the biggest things, and then your auto loan. But aside from those 2 things, you should ideally have 0 debt in credit cards, 0 debt in student loans, 0 debt in general, unless it's something positive, like maybe your mortgage or a business loan, or again, like I said, your auto loan, which eventually you should pay off in about 5 years, because that's a typical contract to purchase a vehicle. I don't want to talk about buying car loans right now, but my point of view is you shouldn't lease, you should purchase a vehicle. And I'll go into that in another video, but try to get everything down to 0. Obviously, the mortgage is a big step once you have everything else at 0 under your credit. But stay strong. Make sure you stay on top of your credit. Take care of your name. Take care of your social security number. If you have any questions about your scenario, your particular case, reach out. My information is down below. Again, this is David Rodriguez, your mortgage broker.